All right, guys, perfect. So let's begin today's session. And as I said, that uh, every day of this month, we are going to have a webinar on a different topic. Yesterday, I had conducted a session on financial literacy, and it's so good to see a lot of people who came yesterday have come today as well. And that's a really motivating, really encouraging. And please, by the end of the session, do not forget to review us on Google in Century Financial. We are there, and it really helps us when you give us feedback, when you give us a rating, and it really motivates us to work further and do these kind of sessions for you. So, as I said, today's session is about understanding the investor behavior. And when I say investor behavior, that means you are the investor, and you, as an investor, also have gone through so many emotions when you're investing. So if you take a look back to your life, so many times you wanted to invest somewhere or you invested somewhere, you made profits somewhere, you made losses somewhere. But every single time when you took an investment decision, there was some sort of emotion which was present. And we are humans, and we do have emotions. So how many times we hear this, that keep your emotions away when you are trading or when you're investing? Is this really true? As an investor, and it's a yes or no question again, guys, use your chat options to answer me. Can you really keep your emotions away when you're investing? Can you detach your emotions completely when you're investing? Think about it, give me an answer. Again, it's a yes or no question. Try to use your chat options, guys. Okay, I'm getting a few answers over here. So I understand. Okay, perfect. So I see a lot of you have replied, no, we cannot. And that's not obviously what you just said. It's obviously not that easy to switch off your emotions, because we're human beings, right? Is it really possible to switch off our emotions completely and just work robotic or take a decision without even having a pinch of emotion? It's not possible. Yet people do say that you need to keep your emotions away when you are taking an investment decision, because this is something which is very popular. Why? Because I'm going to today tell you about different kinds of emotional biases which you as an investor come through, and it happens a lot of times even when you are investing or trading. And this happens to us every single time, and we are just not really aware about that it is happening, but it is definitely happening. So our job is basically going to be our job is basically going to be going there to understand that what are these emotional biases, how do we control them, and how do we move forward and continue to invest, right? We are all are human beings, we make mistakes, but we need to be aware about what it actually is. So it's all about mind over money, right? How the behavior of an investor is shaping the investment decisions, because this is a very I would not say this is a very new area of study. Behavior finance is a whole different field, and I have been fortunate enough to dive deeper into it and dig deeper into it to understand that how many kinds of emotional biases actually exist. And we can always sit together, and you can always help with your sit with your consultants and always understand more about it. See, investing can be very exciting, it can be very rewarding, but as I said, it can also be very fraught with a lot of psychological pitfalls. There are a lot of emotional detours. So every time I see a product or a commodity or a currency or an index, there are so many charts, right? Charts and numbers, and they play a very important role, because it's really important to recognize that your financial journey is impacted by so many emotional biases and the decisions which are right there when you are taking the decision, right? So, and before I discuss some of these biases, which can potentially derail your investment goals, let's just understand what sort of biases I'm talking about. And we're going to go through this, each and every bias one by one. And uh, do you have the liberty to use your chat options and send me a direct chat right here, and tell me that if you have gone through that, because this is something which is going to be very common, right? Behavioral finance, as we know, it's the study of the influence of psychology on the behavior of investors, right? So, normally it means that the psychological influence, there are a lot of biases which affects your investment behavior, right? And this is something which has been going on for a long period of time. It's just we notice it very less, and it's the area of study which is focused on how psychology influences the financial market outcomes also. So yes, I mean, there are a lot of these concepts which we are going to go through, and let's understand how do we take care of that. As I always said, that whatever we are discussing over here, um, it's basically for information purposes. But if you want to discuss further anything, please take the assistance of our consultants, and we are more than happy to assist you. Now let's understand how market works, where an average investor gets stuck. So look at this chart. When markets are at a peak, when I say when markets are at a peak, it does not mean it's going up. When reaches to that peak, tell me how many of you when traded or invested. And if you have not, then don't worry, I'm going to tell you about so many investors and traders who have. Then when market reaches to the tip, and let's make it more interesting also. uh, let's open the live platform as well, and let me tell you what I exactly mean from here. So let's take, yeah, why not, let's take a US index itself. Yeah. Okay. Perfect. So look at this peak right here. Okay. I'm going to share my screen. I'm going to show you the live platform. Just have a look at it. Perfect. Okay. If you can see the chart right now, give me a thumbs up or a yes or okay. Use your chat option to do that. Use your chat options, guys. I just want to make sure that you can use your chat options, right? If you can see my chart, if you can see my screen, just write yes or okay. I can see it. You want me to make it bigger, or you want me to zoom into the screen? I can. Please do tell me. Let me make sure that everybody is able to use the chat option as well. Okay. Okay. So I think you can, if you try to send it, you can send directly to me. Perfect. The question now here, this is what I want you to understand. Now here you see this chart, right? And when I say markets have peaked, what does it mean? The peak means, look right here. Look at this tip right here. This is where the peak is, right? So this is where markets have peaked. Can you imagine of one single person, right? Now here's the question. Can you imagine one single person who has bought here, right here, after which the markets fell down? This is what buying at peak means, right? Just look at this peak. Can you imagine any investor who has bought at this peak? Would you buy at this peak? Tell me. Use your chat options, guys. Use the chat options. Let's make this more interactive. Let me enable the public chat itself. Perfect. Would you be able to try to send, use the chat options, guys? Try to answer this. Would you be that person who wants to buy at that peak right there? Would you buy at that peak? Tell me. Peak means after which the market just falls. Do you think that if you get into buying, you can just buy it? So somebody answered yes, probably without knowing it was peak. That's one thing, right? The most important part about a peak is that you don't really know it's a peak unless it starts coming down, how a peak forms. And that's the most important part. So when investors or traders, when they see that markets are going upwards, they wait and they wait and they wait until they realize that, okay, this has reached, this is going higher, it continues to go high. And everybody assumes that it will continue to go higher, and they buy. And the very moment the market starts coming down, and that's what buying at peak looks like. Now, when markets are coming down, you start getting panicked. And I'm losing in this. Why did I enter it all? And then you keep holding on to it because you're just regretting at the moment. And when market goes down, when it bottoms, exactly, a lot of times now you don't have the holding capacity anymore, or you're just tired and you feel that, you know what, I should get rid of this. I'm not able to sleep, I'm going through this nonsense, this market never makes money, this is just gambling, and I should not have done it at the first place. And you start cursing anyone, and then you sell off everything, and after that market starts moving higher. And then you start feeling that, oh, okay, you know what, it maybe now it's the time when I should enter. And the moment it reaches to the peak again, you can buy at the peak, and you feel that you're the most unluckiest person in this world because you bought at the highest and you sold at the lowest. Let me tell you, ladies and gentlemen, you what you just did might describe 75 to 80% of the investors. You're not alone in this. If you had done this before, stop beating yourself up, because this is something which is very common. And that's where the behavioral finance steps in. This is where it's important that you must understand that what is going on and how do you control these kind of emotional biases. So let's try to understand that what these kind of emotional biases are. Okay. Now, we go through a lot of these biases, and again, the when you start looking at so many biases, don't think that this is something which you have to always remember. I am trying to make sure that I give you some examples which helps you to really connect this with yourself. And as for example, let's take an example, anchoring. Right, anchoring is one of those emotional biases which we face a lot of times. A lot of investors, a lot of traders, they often hook on to the readily available information, such as analyst forecast, and then they use them as anchors, making it challenging to objectively assess the new data. What does now, when I say this, so you know how many times a lot of these analysts, they do recommendations, they give you a price target. The price target for Amazon is XYZ, the price target for Nvidia is XYZ. So that price target, sometimes in your head, it becomes the anchor. So if you feel that if that target has reached, maybe it's the time to sell. You never think that it might go further higher, right? It's just like that. So for example, if you're looking for a job and you gave interview at one place, and they offered you a salary of say 10,000 dirhams, then that 10,000 dirhams becomes a sort of benchmark for you. So if anybody is offering you less than that, you're thinking, no, I need at least 10,000. Maybe you value more than that. But because that was the first available information to you, it kind of became an anchor. It established a range of reasonable possibility, right? Because that's where this was the first information, this was the first establishment, this was the first interview which you gave, right? So it kind of forms an anchor to your mind. So sometimes what it happens, uh, tell me one thing. Um, if I would ask you, can anybody type the gold prices using your chat options, guys? Use your chat options. Can you write the price of gold right now? Whatever you remember, or if you even Google right now, let me know. In dollars, dollar per ounce. Write the price of gold. Let's make this more interactive, guys. I'm sure everybody is very much in front of Google. Google is available. So even if you don't know, just search it out and tell me if you know the price of gold right now, dollar per ounce. What's the rough price? So for those people who are not able to use your chat options, I think you can send the message to me directly. There must be an option on the chat window as well. Okay, perfect, perfect. So I'm receiving a lot of messages here. One second. Okay, somebody wrote chat disabled, but I can actually read. I can read your chat. Okay. See, go ahead. If so, a lot of you, if you find out anything, if you want to write, use the only questions options also, and you can write it there as well. Do not necessarily think about chat. If you see the question and answer point, just write over there, and I'll be able to get your chat. So I think, yeah. Now I think a lot of you can see. Perfect, perfect. So only even if you see Q and A part. So if you can see Q and A, just type it down on Q and I will get your chat results also. So continue to use Q and A for every question I ask you. So yeah, some of you said 2479 2480. Now for those people who are not looking at gold prices, currently it's 2480. If you start looking at gold today, you feel that this is the price. Tomorrow if gold is 2500, you feel that, oh, gold prices have gone up, maybe it's on the higher spree. If it goes below 2480, somewhere around 2470 2460, you think it's going down, because today the price which you have seen is 2480. This has formed an anchor in your mind, right? Had you started looking at gold 10 years ago, it used to be 1100 also, it used to be 1200 also. So somebody who has started looking at gold back then, for them, gold is really overvalued. It's really expensive, right? So I would not be surprised if they are looking for a price which is somewhere near 1400 or 1500, right? So it basically depends on what information is available to you. So we have to understand that we should not take our investment decision looking at the current price and doesn't should not make that as an anchor, right? We should start looking at historic data, that how much it was in last 10 days, how much it has gone in last 20 days, how much it has gone, and then we should take our decision. So there's one suggestion here: many shares are at an all-time high and still climbing, and let's still recommend those shares based on price action, irrespective of price action, irrespective of PE ratios. How does one view this from a behavioral psychology perspective? Also, what is the action needed, buy or no action? So guys, here's the question. Since we are talking about behavioral biases, it's a very interesting question. So many shares right now are at an all-time high, right? They're still climbing. There are a lot of these analysts which are recommending that you buy these shares based on several areas on fundamentals. How does one view this from a behavioral psychology perspective, right? And what is the action which is needed, buy or not? So first and foremost, so very good observation here. Important part over here is that today, if the analysts are recommending and you feel that shares have reached to its highest, right, are at an all-time high, does that mean that if they're at all-time high, they must come down? Or would you trust an analyst? If you're trusting an analyst, you need to understand why they have recommended buy or sell. The only way to go through this is do your research. That is where the consultants and analysts come into the picture. The best way to understand whether you should buy, especially in terms of shares I'm talking about, because shares are nothing much. They are companies. Companies are balance sheets. Balance sheets are numbers. If you can study a balance sheet right, then you can take a decision which is not based on your emotion. It is based on statistics. It is based on numbers. If your research says that it's a good buy, then it should not matter whether it is at all time high or not. You should still go for a buy. That is why it is important to do a proper research. You don't just listen to analysts because they said something. That is also a bias, by the way. It's called herd mentality, when you hear others talking about buying and you just buy without doing your own research, right? So research is something which is really important, right? So after anchoring buyers, it was a very good question, guys. Were a very good question. So keep asking more, because this is something which is very common. It comes across a lot of people's mind, and it's good to ask out. Second bias is availability, where people really overestimate the importance of information which is available to them. And it happens. So the example which I have given over here, so you can easily remember, so many people feel that smoking is okay because they know somebody who used to smoke 3 packs a day, lived 100 years or 80 or 90 years, and nothing happened to them. So you feel that, you know what, smoking is healthy. But what you're doing, you're basing your decision on the basis of some information which you have got, but you're overestimating the importance of that information. Maybe out of 100, 3 people who have survived and uh, gone this way and have not been affected after smoking. Maybe the remaining 97% of them have been impacted. So when you overestimate the information, and I'll tell you exactly how this bias occurs. So um, if you remember, when pandemic happened, immediately the prices of Novavax and Moderna, their stock prices went up, because those were the companies who created vaccines when SARS and MARS and these respiratory syndromes happened uh, back in last few years. And when COVID happened, everyone realized that these are the two companies. They have created the vaccinations back in the past, and this time also they are going to create the vaccination. So their stock price shot up, even when there was no vaccine. And when vaccines were actually manufactured, when they were actually out, the stock prices came down. Why it happens? But there were a lot of investors asking me the question that, Yogesh, now vaccines are out. Shouldn't price of Moderna and Novavax should not go up? It should not go up because that information has already pushed prices higher back in March 2020 when the vaccines were not even created, right? So now when they are created, the information which you have got, you are overestimating the impact of that information. That information has no significant impact, so stock went down directly. So availability is one of those bias which you need to be very careful from. How do you protect yourself from availability bias? You gather all the information you can and see the macroeconomic picture. So, for example, uh, this happens a lot of times. Gold prices, a lot of times it happens. Gold prices, they move up when there is a uncertainty or a bad economic data comes out. So, for example, job numbers expected to come good, but they came bad. Not enough jobs were generated in US. So now, when that happened, gold prices came down. Now everybody is asking that, oh, job numbers are not good, so why gold prices came down? So sometimes what happens is that if job numbers are not good, uh, maybe or let's take an example. When we take a macroeconomic picture, when we take a bigger picture, so the bigger picture at hand is whether central bank of US is going to cut interest rates or not. Now, if a manufacturing data comes out, will that manufacturing data push central bank to cut rates? Or is there any bigger information which will influence Fed's decision? That is the question. But sometimes what happens is we try to overestimate the information because we have placed a trade which says that I should be buying gold because Fed is going to cut rates. This is what I have believed. But every small news coming which is bad, I feel gold prices should go up. So I need to not look at those small economic data. I need to see the bigger picture, that if Fed has hinted the rate cut is going to happen, I should be buying gold and not selling it. Just because one data came stronger does not mean that gold prices needs to come down. You need to see the bigger picture, that how the central bank is inclined towards cutting rates. So this is something which we have to understand when we are looking at the availability bias. And this happens a lot of times, guys. A lot of times we hear people thinking that, oh, this news came out, but why the trade is going on the negative side? Because the impact of that news is not that much. You are overestimating the impact of that news, right? Now, another bias is the bandwagon. The probability of one person adopting a belief increases based on the number of people who hold the belief. So this is basically a group thinking, right? Why a lot of times it happens that one person who adopts a belief, it's based on the number of people. So it happens to a lot of us, because if you see, and I'll give you a very important example over here, because this is something, it happens a lot of times. Biggest example is fashion, right? All of the time when we see something going really well, we just climb that wagon and get into it. And this is something which happens. Let me give you an example in case of investments. How price bubbles happen, right? Why, like how Bitcoin prices just continue to go higher and higher and higher. What happens? Because when people see something is going up, they would want to buy without even thinking. They feel that they are following the trend, but following the trend means when you fundamentally or technically believe that this is the reason why it's going up. But sometimes people just tend to buy something because everybody's just buying and the prices are moving higher. Tech stocks are the biggest example of this. Sometimes you see tech just continues to rally in spite of what is happening around the world. Bitcoin is the most important example, because that's where the bubble starts forming. So wherever you see a price bubble has formed, that everybody's just buying and buying and buying and buying and thinking that, now it's just too big to fail, and people start buying this, that's where that bubble bursts and everybody falls. This has happened in 2001, when, without even thinking, if people would see that company ends with a .com, that means it's a tech company, which means let's just buy because tech is the new thing. So people are, and investors, they always look for something new, right? You look for a product which you can just keep buying and the value of it goes. How many of you, so again, yes or no question, guys, how many of you have bought um, how many of you have bought cryptocurrencies, kept in your wallet? Bitcoin, Ethereum, Ripple, any cryptocurrency. It's a yes or no. If you have done, write yes. If you have not, just write no, and that would be enough. Yes or no, guys? Yes or no? Use the Q&A part. Use the Q&A option to write it. Where you see the Q&A, click on Q&A and use your um, option to write. Okay, I have a yes, a no. Okay, yes, no, yes, 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 yes. Okay, 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 okay. I must say the crowd is divided at the moment. Some of them have said absolutely not. Some of them have said yes. If you have bought cryptos because you understand what a cryptocurrency does, then it's okay. But if you have just bought because you feel it's going to go up, because you have seen it going up, you don't even know what it does, then you are into a bandwagon impact, because you are just buying because you feel that the popular opinion out there is buy. If you don't know what a cryptocurrency does at all and you're still on the buying side, that means you have joined this bandwagon. Now, as long as you're making money with this, that's fine. But when you start losing, you will not know what hit you. So, again, the important part is you should understand the product you are investing in. And that comes when you sit with your consultants and they tell you, right? Or you try to get more and more information with your fund manager that how it actually works. Next is the blind spot bias. Again, blind spot bias is something which is very common also. We have seen this is basically failing to recognize your own bias. You are doing a mistake, but you don't realize it. So a lot of times it happens. Um, we do not understand that we are in a bias. That is also a bias. Not being able to understand that I am biased at this point, because we are trying to find out other people's mistakes so much that we don't see that we are the one who are also committing a mistake. So this happens to a lot of us, and not just in investments. I think it happens in so many parts of our lives as well. But see, the important part is that you need to be aware. Always try to, so one way to get out of blind spot bias, and it happens, right? If I were to take an example of the blind spot bias when it comes to investment, right? There are so many examples we have seen, and even a lot of times, like for example, how many times, uh, if if you feel like, for example, let's say, if you get, if you're looking at people, some of them people are giving you an opinion about something, right? How many times it happens when somebody has given you an opinion, and if it doesn't matches with yours, you feel that they are in the wrong, because you feel that you have more clarity than others. You know that other people are more flawed than you. That is where the blind spot bias comes into the picture. You need to understand this, guys. If you feel that you are always on the right side, then it's a big problem, because the tendency of thinking that it will not happen to us, it will more happen to others, that is where we are in the wrong. So the most important thing when we are looking at the blind spot bias is be humble and always keep a check on yourself. How you do that? Maintain a trading journal. This is how you get out of the blind spot bias, guys. Maintain a trading journal. If you do an investment, if you place a trade, write down what was the rationale why you placed that trade. If that trade goes right or wrong, you go back to that reason, that there was a reason I did it. Why did I do it? And then you compare was that reason good enough? And then you will realize that this was a wrong reason. It did not work out. So you will go back and correct it. But if you don't maintain a trading journal, then that's a problem, because you are thinking that what the decision which you have taken is right. And that's a blind spot bias. Next is the choice bias. When you choose something you tend to feel is positive, right? Even if there are flaws, you have the choice to see the flaws, but you choose to see only the positive about it. So let's say, for example, if you own a pet, you have a dog who's really nice, very cute, very fluffy, but once in a while he becomes aggressive and bites someone, but you still feel that your dog is the best dog, even if he bites someone once in a while. You choose to look at the negative, you choose to only focus on the positive. Now we know that how we have, a lot of times we are told that never focus on the negatives, focus on the positives, and that's good. But when it comes to investment, and if you have placed a trade and you see that you are in the wrong, not do not think so positive that no, it's going to work out. If you're in the wrong, then you are in the wrong and you need to make it right. So this is something which we have seen. Choice supportive bias is a very important bias. This, it happens a lot of times that if a person chooses one option instead of choosing the other, they will ignore that fault. They will always amplify that, this option is right, if I because you have chosen this. So even if you are choosing, if even if you're looking that the one which you have chosen, it's not the right option, even if you can see this, that the one which you have chosen is not the right one. It happens so many times that you try to justify your past choices by remembering the positive aspects of them, ignoring the negative ones, right? So this is actually a double edged sword, right? It gives you a lot of confidence in your choice, but then it kind of prevents us from learning from mistakes also, right? How many times you make a mistake, but you feel that, you know what, under the circumstances that seemed like really good decision, and something positive came out of it. I mean, that's okay, but you need to learn also from your mistakes. This is something which is really important, guys, because you need to understand the difference between uh, looking in things into in a positive manner, and at the same time have to have a very clear difference between how you see things in a very positive manner, but refuse to learn from your mistakes, right? Because it can be a very powerful tool for a lot of financial institutions to help clients achieve better financial outcomes, right? We have to understand how this biases can work, and we have to make sure that the clients. So how do you normally do? You don't have to be defensive when you talk to your consultant, and if he or she tells you something that, see, you have to be careful, you should not have done this, this is a wrong trade which you have placed. So you need to be acceptable of that part, right? You need to understand. You don't just think that, okay, under that circumstances it seemed like a positive decision, so I did it. You need to understand that you were wrong and you have to move on with it, right? Another is again clustering, tendency to see patterns in random events, right? Now, this is a key to various gambling policies. So, this is a very, very common bias. It happens to a lot of us. The clustering bias. We try to find out patterns in random events. It does not even matter. Like when, if you're playing a game of roulette, there's a red side, there's a black side. When you spin a ball in that bowl, either it will be a red or a black. But just because it has come black 5 times, it does not mean that the next time it's going to be red, just because it has happened 5 times in a row. So, a lot of us, we actually fall into this trap because sometimes what we see, how it happens, we try to see that, uh, okay, this particular stock hit one high, it just hit another high 3 days in a row. Now that means it's just going to go up. No, it's not like that. You have to see the fundamentals of the stock. Just because you see 3 days in a row and it's moving higher, it does not justifies you buying a particular stock. You need to do your research also. So clustering is one of those, or sometimes when you're looking at economic events, this happens so many times that if jobs data has come positive 3 times in last 3 months, we feel that, oh, fourth time, no, this time it may be negative because last 3 times it was positive. No, it's not necessary. It's not necessary that if last 3 times jobs data have come positive, or GDP numbers have come positive, or oil inventories have come positive, this time is going to be negative. No, there is no pattern in this. But we still try to find out the pattern because we want to be right. We want to place a trade. We refuse to accept that, there is no pattern, there is no trend. We need to find out a pattern even in random things. So that's what clustering is all about, and we should not get into this, right? Next is confirmation, which happens so many times to a lot of traders I know, a lot of investors I know, and a lot of people I've met tend to listen only to the information that confirms our preconceptions. So many reasons it's so hard to have an intelligent conversation about climate change. I mean, so many things, right? Not just climate change, but think about so many things, just because you only listen to the information that confirms your preconception. So if you feel that, uh, say for example, trading is for gamblers, if you believe in that, then you will only connect with people who are telling you this thing. Anybody telling you otherwise, you will not accept. You will say, no, you know what, I've met a lot of people, everybody says the same thing. The fact is, you are only taking that news which confirms your thought. And how it works in investment times. How many of you, when you buy something, let's say, okay, write anything which you have purchased in terms of investments, a stock, commodity, currency, index, anything. Use your Q&A. Write it exactly what you have bought in your trades, or any stocks, or any mutual funds, or any currencies, or cryptocurrencies, or index. gold, silver, crude oil, platinum, palladium, Apple, Facebook, Google, Tesla, stocks, mutual funds, anything, whatever you have purchased. So there's a question here: how's clustering different from confirmation? See, clustering is about uh, trying to find out some sort of pattern, right? So whatever information you get, you will get a lot of information, but here your focus is on identifying some sort of pattern in whatever information is there. On those bases, you want to place a trade. In case of confirmation, you already have a preconception that this is how it works, right? You already have a preconception, because maybe you are buy on gold right now. So the why I was asking that, tell me something which you have bought or not. So I would give you an example. Let's say you buy on gold today. You will only want to hear news which supports your trade of buying gold. Anybody tells you that why gold is a good sell, you will not hear it, but you will give more importance to the news which will say that why gold is a buy. And that is what confirmation bias is, right? Clustering is more of a tendency to just see patterns for no reason, right? You just try to find out, okay, if in 5 times gold has fallen down, so 6 times it should go up. There is no such thing. It does not work that way. In case of confirmation, you have already placed your trade, you already buy on oil or gold, so now you're looking for the news which shows that gold will go up. Or if you are buy on Apple stock, for example, so you will start looking at every single news which which is expected to push stock higher, or which you feel is good for the stock. So if a new iPhone is coming, you would be happy because, oh, a new iPhone is coming, this is really going to boost up my stock. So you are very happy. You don't even know what the design looks like. You don't even know the future sales looks like. You have not read the balance sheet of the stock at all. Nothing. You have placed a trade, and now you're only looking for a positive confirmation for your trade, right? That is what a confirmation bias is. Here somebody just shared something. I bought a GRSE share when it was at an all-time high. Prices went up further for the next few days, then it started falling. But I'm yet to dispose the share on the hope that it will reach the peak again very soon. Now, you bought this share, it went up, and now it has started coming down. You are still hoping that the share will go up very soon. Now, if you're hoping it will go soon, then here there is some sort of bias, right? Because it happens, either it is confirmation or conservatism. Because conservatism, which is the next bias, is where when people favor the prior evidence over the new evidence. So right now, your prior evidence was that the stock was good, you bought it and it went up. But now when it has started coming down, you are still stuck on the evidence which you had before, because you are not accepting it at the moment that the stock has come down and might go down further. Now that is conservatism as a bias. But right now, if you have done your research and if you feel that no, the balance sheet of the company is very strong, and even if the share is falling down, then you would want to buy more and stick on to it. But if you have seen the balance sheet also, if you have seen the earning per share also, and you feel that the stock is going to come down further, but now you don't want to sell it because you feel that you have already made up a loss, right? You did not book profit. So this is also called loss aversion, where people tend to hold on to the stock when it's falling, right? But sometimes they quickly book profits, and when they're not booking profits, if it's coming down, they are adding more to the falling trade because they are afraid to lose. They don't want to book the loss. So every trade is in a bias unless you have done your research. And when I say research, it means independent, unbiased research. So GRSE share, for example, if you have bought it and it has started coming down from an all-time high, you should know that what is the reason why it's coming down. And if it's a good enough reason and it has continued to come down, you should cut down your losses, wait for it if it comes down so that you can buy back again. But if your research shows that it's just a minor correction and after that investors will enter again, then you can still continue to hold on to it, right? So do not have conservatism bias over here. If your prior evidence supported your buying but the new evidence does not, then you should not take time to accept that this trade is going down, right? Need to do your research. Okay. So perfect. Like for example, you have read it's a zero debt company. The company secured new orders, yet the price came down. So you need to find out that what was the reason, why did it come down? It's just a market correction. Is the index coming down, and that is the reason why stock is coming down? If your balance sheet is strong, then you continue to hold on to it, right? But you need to see your risk and reward as well. Now, next is information bias. Again, information bias occurs when people have access to a broad range of information, choose only certain sources that align with the pre-existing beliefs. Is what I normally discuss. It's more of same as for the confirmation bias. That when there is a lot of information available, but you only choose to pick which confirms your pre-existing beliefs, just like confirmation, right? Then there is something called ostrich effect. Ostrich effect is also very popular. It's also called as ostrich problem. This describes basically how people avoid negative information, including the feedback that could help them monitor their goal progress. Right? It's something what we kind of came into. Right? See, a lot of these biases are very similar, but you see how close we are getting to address these problems. Like for example, let's say you have been eating out a lot recently, probably more than you should. Now, you know that you should check your bank account balance to see what the damage is. But every time you think about doing, you start to feel anxious and you know the situation is bad, but you don't want to see how bad it is. And in the end, what happens? You keep your bad spending habits, but you never check to see how much money you are spending. You know what? This is a very classic example, the ostrich effect. I have known a lot of people who place a trade, a couple of really bad trades, and then they start getting into a loss. Then they just stop checking their trading account. They never log in again. And they feel, what's the point? It's still in a loss. It's still in a loss. Instead of cutting down the loss, now it's. So they just stop looking at the losses at all. They feel that if I close my eyes and don't look at the loss, it will go away. That's not how it works. So this is a classic impact of ostrich effect, that when you place your trades and they start getting into a loss, you should cut down those losses and realize your loss. You should realize that you are in a loss. Closing your eyes or putting your head under the ground does not mean that problems are over, right? So this is what an ostrich effect is. Then outcome bias arises when a decision is based on the outcome of the previous events without regards to how the past events developed. So again, outcome bias is something which is very important. Again, as I said, that it arises when a decision is based on the outcome of previous events, right? It does not involve analysis of factors that led to that event, right? So how it happens, a lot of times we have seen, uh, like some of you would argue with a very impressive growth of social media companies like Facebook, for example. Now, during this growth, only a handful of people were cautioned against the methods by which the growth was generated. How social media companies grew, only few people know that how this growth was actually generated, right? What was the reason? Private user data was a very significant driver of the growth, right? Now, what is the outcome bias of social media? uh, this is something now we feel that every social media stock has to move higher. Just because it is tech, it has to go higher, because we have seen that tech companies in the past have moved higher. So we feel that now any tech company which comes now will move higher. This is the outcome bias, because our investment decision is based on the outcome which came previously in a past event. And on that past event, on the basis of those past events, we are taking still our investment decisions, right? Not every tech company is a good company to buy, right? So you have to understand this. Outcome bias is one of the very important things, because when we are taking a trade, just because it's a tech company, because this happens a lot, any biotech company today, if you filter it out, you will see there are so many biotech companies. Right now it has $1 or 50 cents. A lot of people would buy 100,000 shares of this. 50 cents becomes $1. I will have 50 cents in 100,000. I'll make $50,000 profit just like that. It's only a matter of time. No, just because it's a biotech company doesn't mean that a drug will get approved and it will get acquired or merged. But because we have seen that happening in the past with some of the companies, We feel that this is how it has to. So outcome bias is also something which we need to be very careful about. Next is overconfidence. We all know what overconfidence does to us, not just in investment, but in anything else. This is for the recent traders, guys. If you have done some trades, 6 of them gone right, 8 of them gone right, does not mean that every single trade will go right. Don't think you're the god. Don't think that you can time the market. You're not the best there is. You're not the best there was. Anything could happen. So do not get overconfident in your investments. Do not get overconfident when you are placing trades. What happens, a lot of people, they take heavy leverage, don't put a stop loss, and they feel that they, just because they have done 5 or 6 trades and it has gone right, they know how market works. That's a myth. That's a bias which you face, right? Then, of course, there is placebo effect. Placebo effect is also one of the very, very important impacts. We also call it sometimes, in our daily lives, we have seen how placebo effect happens. Uh, Sometimes we feel that we are not at the 100%, but the moment someone tells us that no, you know I have just given you something really nice. Now it should work for you. You feel that now it's working. See, it's very fascinating. Placebo effect is real and it's very fascinating. And whether you talk about in the field of medical or marketing, it works. How many times you're not feeling well, but you go to a doctor, gives you something, and it tells you that now you're going to feel well. Most of the times it's the medicine, but it's also the mindset, right? Because you're not in that placebo effect that now you're thinking that it's going to work. So in when we see, basically it's like a beneficial effect which is produced, right? And it happens just because you think about it. It's on the base of your belief. Now in terms of investment, which is when I say again, when there is a certain investor belief that that activity is going to happen, what kind of activities might be captured when I say, for example, in short term trading, or when we are trading on macroeconomic news, or when we are kind of looking at active mutual funds, when we are trying to chase some performance, placebo effect is very, very important, right? We have to understand that a lot of times when we are doing investments, we have to see that, especially in the investment industry, it seems irrefutable that there is a preference for action over inaction, right? Because there are so many price fluctuations, there's so much obsession with the latest headline risk, urge to do something which can be irresistible. What if I miss out? What if things go wrong? What if I have done nothing and everybody just made money? How can I just sit there when all of it is happening? What are my clients going to think? There's so much stress and anxiety created, and that is where we have to see that this is something which can cost us a long term money. So be very careful when we are talking about placebo effect. To give you a better example for placebo effect, sometimes we feel that how there is so much FOMO among the investors, fear of missing out. This is a perfect example, and this is a very recent example. Uh, I think this is something which we have seen in so many traders. FOMO. If markets have started going up, how you end up buying on the peak? Because you did not enter when it was going up. But then you started thinking that, oh, what if I miss out on this? Now, in your mind, you're thinking that I am definitely going to miss out on this and I should enter. You're not looking at whether the trend is ending or not, but there is some sort of drug in your brain which is pushing you higher and higher and higher and higher. And you're thinking that now I should buy, because if I don't buy this, I'm going to miss out. And you end up buying exactly at the peak. So this is something which is it happens a lot, and it creates a lot of anxiety. Placebo effect is followed by a lot of anxiety because we feel that we are not doing anything while others are making money. We are not doing anything. So let's do something. How many times you log into your trading account and just take the trade without even looking at the levels? What is the stop loss? What is the take profit? Is it a good time to enter? Like, for example, if oil has come down today by 3.5%, 4% drop in oil today. Now, a lot of people would just jump in and buy oil. Why it has gone down 4%? Now, what if from here, if it moves up? You have not even done your research to see that what if it's a long term fall. This is what a placebo effect is. So you need to be careful about this. Next is the recency bias. Recency bias is basically when you place more emphasis on the experiences which happened right now. So, for example, if you have seen, how many times you see a horror movie and then you can't go back to sleep. So, a lot of you avoid watching horror movies in the night because you feel, no, no, I'm going to be alone in the night. That is recency, right? You just saw a movie and now you feel that that particular thing is going to attack you also. Recency means, in terms of investment, that when you see a recent information, you place too much emphasis on that. So if you have seen that the Nvidia stock was a great example, like last quarter, stellar earnings, this quarter, very good earnings, but the stock is still coming down. Why? Because the expectation from Nvidia is much, much higher now. And people bought the stock thinking, oh, the stock went up, last quarter was great, so this quarter should also be great. They went on, but the stock came down. So recency bias is when you put too much emphasis on the recent information which you know about the company, but you have not seen the overall understanding, even if it is the not the most relevant or the most reliable information. So recency, and also sometimes when you're choosing your fund managers, right? A lot of times when you choose your fund managers, you look at their performance of last 2 or 3 years. Let's say last or 2 3 years, if markets performed well, you are going to buy. You're not seeing that what is coming next. Your trade is just based on the recent information. So we should try to avoid this, right? Because in the investing world, it can be again hard to avoid, because a lot of clients, they display the recency bias when they make decisions based on recent events, expecting those events will continue into the future. And this leads to overconfidence. It leads to so many irrational decisions because we see something which is very hot. Fang, if someone knows, what was Fang used for? Facebook, which is now Meta, Facebook, Apple, Amazon, Netflix, Google. For years, these five stocks were considered a sure bet by many because they grew faster than both S&P 500 and Nasdaq, right? But and recency bias might have led an investor to continue holding Netflix also, despite the widespread revaluation of tech stocks in 2022. In 2022, Netflix stock went down more than 50%. By June 2023, stock was still down by 27%. But again, we continue to buy Netflix. Why? Because we have seen tech stocks moving higher again and again. So we should focus more on what's the current information rather than on what is the recent bias. Then there is something called salience, choices driven by the information that is communicated to us and the things that we see. So as a result, we have a tendency to fixate on information that is distinctive while ignoring anything that does not particularly stand out. So salience bias is also something which is very, very important. It's basically quality of being particular, something which is very easy to notice, right? How many times in the area of marketing we have seen something which looks more flashy, we move towards that, right? And it happens a lot of times. I mean, something which so I would not take names, but there are so many food apps. It gives you push notifications. It looks so nice, right? And you tend to order. This is what salience bias is. That whether you're hungry or not, you see a nice push notification, you see something more decorative, something nice, and you want to enter and buy it. So that is salience bias. Need to be away from that. Selective perception, again, is the unconscious process by which people screen, select, notice objectives in the environment. During the process, information tends to be selectively perceived in ways that sign with existing beliefs. So you believe in something, you have a selective perception that no, this is the particular company which always does well, you buy it. Something which we always face, should try to avoid that. The last four, stereotyping. It's also called implicit bias or explicit bias, right? When you basically refer to the stereotypes, right? How many times it happens in investment that you feel that this always has to go up or this always has to come down. You don't really feel that what is the reason behind this, or a tech company always goes up, a tech company always makes a lot of money. This is stereotyping, so we should definitely avoid. And the answer to this is by doing more and more research. You can do that. Survivorship bias. tendency to view the performance of existing stocks or funds in the market as a representative, comprehensive example without regarding those that have gone bust. This happens again. So here somebody just pointed out about stereotyping, seeing a red car just because you bought one red car. It happens a lot of times, of course. Even in survivorship bias, you normally what you do, you tendency to view the performance of an existing stock or fund. So if you see that this fund has performed uh, well right now, currently, you want to buy it without even thinking that which of these companies in this index have gone bust. So you see the performance of existing stocks or funds, and you forget about the companies which have gone out or which are not there at all. So there are a lot of these biases which have been there. Zero risk bias, again, very important. And zero risk bias, I'm not sure how many of you have actually heard about it, but this is something which plays a very important role. I'll give you one example. Did you hear that when pandemic happened, a lot of people actually started buying toilet paper at bulk? What was that? That was a zero risk bias. Why? Because people, they thought like this was basically when the pandemic happened, people were juggling a fear of contracting a potentially life threatening illness, right? Worried about the uncertainty of job. Now, what you do, try to, when you are trying to tackle a issue, you love the idea of eliminating at least one type of risk completely, right? So when you find something complicated, you try to eliminate at least one threat in its entirety. So what people did, okay, I cannot save myself from this disease at all. I cannot save myself from losing my job. What I can do, at least I can buy toilet rolls in bulk, because I will eliminate at least one risk. I will have enough toilet rolls, so I'll not go out of the toilet rolls. This was a zero risk bias, right? Because you have eliminated at least one potential threat of not being able to go to the loo at the home due to the lack of resources. So for you, that's a win, but you don't see the bigger loss, right? So this is something which can be, I mean, this is some sort of a crazy behavior. It's over the top, but again, it really happens because you know how many times you say that, okay, that's one less thing to worry about. So if out of 10 trades, one of them is showing green, you are not worried about the next few red. You are more focused on that one green. Why? You're like, okay, at least this thing is in profit. No, you have to focus on what is in loss, what should you do. Can't ignore that part. So zero risk bias is that. And then the very popular hindsight. Hindsight is always that, oh, I knew this would happen, because that justifies. You lost your money in recession. I knew recession was coming actually. Few months ago, I was telling everybody the recession would come. This makes you feel better that you predicted it right, but it again does not stop the fact that you lost money. So hindsight bias is always about uh, when you make a loss, you'd say it's okay. I saw that happening. I already predicted it's going to go down, so I knew it's going to come down. It's basically your way of telling you that you already anticipated, but you did nothing about it. So you are accepted the loss at your own will. It's a bias. You need to understand that you did not know it was happening and you were caught off guard, and you should have risk management procedures to protect that. So what should be your trading position? Never add to a losing position. Always determine a stop and profit when you enter into a trade. Place stop losses based on market information, not on the basis of your account balance, right? If the stop loss is too expensive, don't do the trade. Don't think that. You should always look at the part that just because you can held on to a trade for a longer period of time does not mean that your stop loss should be much lower, right? Look at the chart where the market says that, okay, if this particular level is breached, then the markets might expect it to come down. So don't put too big a stop loss. Again, your decision to exit a trade means you perceive changing circumstances. Don't suddenly think you can pick a price and exit the market. Your entry and exit should be planned. Support and resistance is important. If there is a price from where it touches and bounces back, you buy there. If there's a price which touches and come down, you sell it there. So your entry and exit should be planned. It's not random that, okay, I see a green and I click close out. Because your losses are not going to be like this. You will keep adding to your losses. You keep adding positions to your loss, but you quickly get out of the profits. That's not how it works. So many of the traders I know making $2,000 loss, but the moment they see $200 profit, they get out. That's not the right risk reward ratio. Lastly, need to have a disciplined routine. You determine the market trend, determine the support and resistance level, accept the risk, write a trading journal every day, guys. This is really going to help you. Write it down, why you have placed a trade and what is the reason behind it. You do it every single day and you will realize this will actually help you to explore more and more information also, right? So this is something which was really important to discuss today, guys. Thank you so much for your time. Please review us on Google. We are Century Financial. If you like the session and this presentation, you can download it later on once it is uploaded. And the recording of this webinar will also be there on the YouTube. And we'll have a different session tomorrow. It's probably on market neutral strategies, something very different from what we have discussed today. And as I said, that we are going to be here every single night in the month of September, 7 to 8, to give some awareness about different topics. Yesterday it was about financial literacy. Today it was about behavioral finance and psychology of investors. We learned a lot of biases today. We tried to understand that how we can try to avoid these biases. At the end of the day, all of us are humans, and please do not neglect the last point here. Come to us for a cup of coffee and sit with us and just try to learn more. That's all I can say. I mean, it does not mean that every single session has to end with opening of a trading account. Just come with us and understand that how you can avoid. Take a demo account from us and try to take trades like you would do in a live account, so you can understand from your mistakes, right? Diversify more, put your stop losses right, learn with us about technicals. We're going to have a technical analysis session also in this month, so try to understand that where we can excel. And I hope to see you guys tomorrow for the market neutral trading strategies. And this is again, the next session is going to be really really nice. So we are going to explore a lot of trading strategies tomorrow, especially related to market neutral. And it's going to be something really different from what you have seen in the last two sessions. And I hope to see you every single day. And again, please review us on Google. And if you have to have any one-on-one sessions with me, just reach out to your relationship managers, and we can do a one-on-one personal session with you while we are doing these sessions as well. So maybe tomorrow afternoon, if someone wants to catch up with me, I'm available over a Zoom call or a Microsoft Teams. Or if you're coming to the office, we can definitely sit and understand more. And till then, let's hope that you join every night and we get to learn something new and something different. And my name is Yogesh. I'll see you tomorrow once again on the same platform and same time, but with a different topic. So have a wonderful night.